This week's podcast episode is brought to you by Insuring Income. Insuring Income is your source for all things term life insurance and own occupation disability insurance. Insuring Income has a relationship with America's top-rated term life insurance and disability insurance companies so that pharmacists like you can easily find the best solutions for your personal situation. To better serve you, Insuring Income reviews all applicable carriers in the marketplace for your desired coverage, supports clients in all 50 states, and makes sure all of your questions get answered along the way. To get quotes and apply for term, life, or disability insurance, see sample contracts from disability carriers, or learn more about these topics, visit insuringincome.com/your financial pharmacist. Again, that's insuringincome.com/your financial pharmacist.
Inside of a 529, you don't have capital gains. You basically, that's the tax advantage, that it can grow from 100 to 200 to 500. And that $400 gain, as long as it's inside of that account, you don't pay tax on. That's the beauty of the 529.
You're listening to the Your Financial Pharmacist podcast, a show all about inspiring you, the pharmacy professional, on your path towards achieving financial freedom. Hi, I'm Tim Albrecht, and this week, Tim Baker joins me to do a deep dive into kids' college savings, specifically the 529 plan. We discuss a framework for how to project and save for kids' college, along with the construct of 529 plans, including what they are, tax advantages, what are qualified and non-qualified expenses, and considerations for investing money within a 529 account. Before we jump into today's show, I want to let you know about a free Zoom webinar that we're hosting on July 13th at 8:30 p.m. Eastern called Home Buying for Pharmacists, What to Know, How to Determine If You're Ready, Finding an Agent, Financing, and more. During this webinar, Nate Hedrick, the real estate RPH, and Tony Umholtz, a mortgage manager for Iberia Bank/First Horizon, will join me to walk you through key points about purchasing a home in 2021, how to determine if you're ready to buy a home, and various financing options that are available, including the Pharmacist Home Loan product. If you attend the webinar live, you'll be entered for a chance to win a copy of First Time Homebuyer by Scott Trench and Mindy Jensen of Bigger Pockets. You can register for this free webinar by visiting yourfinancialpharmacist.com/webinar. Again, that's yourfinancialpharmacist.com/webinar. All right, let's get started with today's show. Tim Baker, deep dive on 529s. Are you ready?
Let's do it. Yeah, excited.
So this is a follow-up from episode 195. So we talked about saving for kids' college in that episode, and we're going to link to that in the show notes. But we wanted to dig deeper on 529, given that a number of our clients and the YFP community members are at various stages of kids' college planning, some perhaps on the front end, just getting started, others on the back end, distributing those funds, or maybe even some further along that are helping with their grandkids or other family members' college savings. So we want to dig deeper into the 529. We also had a recent blog post by Dr. Jeff Keimer on 7 things to consider before starting a 529 plan on the YFP blog. Make sure to check that out. We'll also link to that in the show notes. And here we're going to dig into some common questions that come forward as it relates to college savings. Now, we don't need to tell this group about why college savings is necessary. I think many pharmacists are well-versed in student loan debt, unfortunately. Average graduate in 2020 facing about $175,000. This is a $1.7 trillion problem that we have as a country. And so obviously the goal with 529 savings is to try to get out in front of that. Tim, tell us from your perspective, obviously a parent of young children yourself, what is your personal thinking, your framework for saving for kids' college, and not only how you think through this for your own children, but also ultimately guide some of our clients at YFP Planning?
Yeah, so it definitely is a personal preference, Tim. So like I can kind of share with you like my own, and then kind of what I hear from clients. So when I grew up in the great state of New Jersey, the Garden State, way back in the day, my mom was a teacher. My dad worked for a chemical company, Roman Haas in Center City, Philadelphia, and basically the message to us was, "You're on your own, kids. Like figure it out." And that kind of, I think it was partly to light a healthy fire under our rear end to make sure that we were good in school and we got scholarships, and we just put ourselves in the best position to pay for school. They ultimately, I think, did help my siblings. So I think a lot of it really stems back to like how you were kind of raised in terms of your own parents and how they brought you up. So some people, they, it's par for the course. They do the exact same thing that their parents did. And some people, they are the exact opposite. Or if you overlay kind of the horrid state of higher education and what it costs and what it's doing to a lot of pharmacists coming out of school, that also, plays a part. So I've heard everywhere from, my kids are on their own to, I don't want my kids to ever have to go through what I'm doing. So I would like a 100% solution for undergrad and also postgraduate school. Because a lot, unfortunately, a lot of the pharmacists that we work with, I hear this. I don't know if you hear this, Tim, when you're speaking to prospective clients of YFP is, I didn't really have many loans coming out of undergrad, but then when I hit pharmacy school, now I have 150, 175, 200,000. So a lot of people are like, I would just like to get through my kids' undergrad, but that doesn't necessarily solve the problem. So me personally, Shay and I, when we look at our kids and Olivia and Liam, Olivia who's 6 and Liam who's about to turn 2, it is definitely an exercise that we want to help them as much as we can, and we want to be able to have a good education nest egg, so to speak, there for when they do go to school, if they decide to go to school. But we are not on the one side of the spectrum where we're going to forego things that we want to do today, our own retirement, etc., just to hit that goal. So it's a personal preference, though. I've actually heard of clients say, like, we're just going to have the one kid because of the education, and we want to basically put them in the best situation as possible. That's a preference. What I found in most cases is that clients have a semblance of kind of like what they want to do, but they have really no idea of how to actually go about like setting up account or funding it or all of the kind of the ins and outs of that. And that's hopefully some of the things that we're going to talk about today.
Yeah, one of the things that I like, and again, we're talking just basics here in a general framework, and a shout out here to Kelly Reddy Hefner, one of our lead planners at YFP. She mentioned a framework, a third, which, to your comment, there is no one right answer when it comes to kids' college savings. So keep in mind as we talk about these buckets. But I think this is a good, just general framework that folks can wrap their arms around and begin to think about, all right, I like that, I don't like that, or, how do I modify that for my own personal situation? So tell us about what those buckets are, Tim, when we say a third for college savings.
Yeah. So, one of the components of education planning is the funding aspect. We'll talk about the vehicle with the 529 here and more so, but the funding aspect is super important. So what the 1/3 rule states is essentially is that, and this is typically like what we put in front of clients if they don't really know like what they want to do. But then once we have this as kind of our rule of thumb, this is how we basically design the plan around it and actually show them the numbers of what they need to do. So the 1/3 rule states that when you look at the tuition and fees and all the expenses related to going to college, we want to basically divide up where that money is coming through by really into 3 buckets. So the first bucket, or 1/3 of the money, is going to come from current salary. So with that, so we say current, but we actually mean future salary. So example, when Olivia, my daughter, is 18, so 12 years from now, whatever money I'm making, and Shay is making, 1/3 of that we would cash flow to wherever she's going in terms of tuition. So that's the first bucket. The second bucket is basically what we're going to be talking about today, is what's saved, in the past. So this is like the 529 account. This is, maybe a brokerage account, a Roth IRA, a savings account, a piggy bank, maybe an investment property that you invested in. So all the different kind of creative ways that we've basically saved and invested money over the course of the child's life. So that's the second bucket. And then the third and final bucket, it would be the scholarships, the grants, the financial aid, or even the loans that that student is receiving as they're going to college. So 1/3 for kind of cash flow in the moment, 1/3 from what we save and invest in over the course of the child's life, and 1/3 from grants, scholarships, and aid and debt, aid and loans to kind of basically put that picture together.
So let's jump into the 529 plan, Tim, a little bit further, and give us the high level 101 definition of a 529 plan.
So the way that I look at a 529 plan is basically it's like a 401k or an IRA for your education. So the idea here is that you set money aside into an account that you typically fund with after-tax dollars. Now, some states allow deductions and even credits to fund a state plan. So you fund it with after-tax dollars. Those dollars grow tax-free, and then when you distribute them for the purposes of higher education, or even K through 12 now, they come out basically tax-free. So one of the big things that we often throw around is like, what's this whole thing of growing tax-free? So some people are like, well, wouldn't I just invest this or save? So to kind of just illustrate this point, if you are in a tax advantage account like a 529, when you invest, say you buy inside of that account a XYZ mutual fund. So you buy that at $100, Tim. And over the next, so you buy that right in the year of your kiddo's birth. So that particular mutual fund over time, over those 18 years, is going to go from 100 to 200 to 500, whatever the share price is. And then say in 18 years, you sell it for $500. If it is outside of an account like an IRA, like a 529, and it's in a brokerage account, a taxable account, you have to pay tax on those capital gains. So in this case, $400 per share times the amount of shares that you have. So the tax bill on that can be pretty prohibitive in terms of like what is actually left for you outside of paying Uncle Sam. So obviously, if it's held for a long period of time, you have long-term capital gains, which for most pharmacists is going to be about 15%. So inside of a 529, you don't have capital gains. You basically, that's the tax advantage, that it can grow from 100 to 200 to 500. And that $400 gain, as long as it's inside of that account, you don't pay tax on. That's the beauty of the 529. Now, the problem is a lot of people are like, okay, well, what's the catch, right? So for retirement plans, you can't take it out unless you're a certain age and all these other things. And for education, there are some drawbacks. One is if you distribute it that are not for, education costs, there's a 10% penalty. You do have to pay the taxes on it, et cetera. But, if you do use them for, qualified, expenses, then that tax advantage holds true.
Yeah, good breakdown. I think sometimes we just throw around terms like tax advantage and so forth. So that's really helpful. And I'm going to jump into some common questions I think that come up that folks may have about 529 accounts. And some of these are going to be coming from YFP community members who have posed questions in the YFP Facebook group. And I think these questions all fit into, one of two areas. I think when I think of 529, there's really two phases for saving for kids' college. And this feels very similar to how we think about saving for retirement. And that's the accumulation phase, right? We're trying to fund the future need. Here we're talking about the cost of college. And then there's a withdrawal phase. And then we get into different concepts and perhaps some questions around there as well. And you already outlined some of the tax advantages. I think that's probably one of the most common questions. And you mentioned how the taxes can work in terms of that tax-free growth. And then as long as we're using them for qualified expenses, we can pull them out without penalty. And then you also mentioned that many states offer some type of state income tax deduction or credit. And I just want to give folks one example of that here in Ohio, in the great state of Ohio. Ohioans can deduct their Ohio 529 contributions from their Ohio taxable income up to $4,000 per year per beneficiary. So, when you're talking about that from a state savings, is that, huge sums of money? Not necessarily, but, every little bit helps in terms of what you might be able to save on some of your state taxable income. So Tim, let's talk about qualified and unqualified expenses. So we want to make sure, of course, that if we're saving this money, you mentioned, what's the catch? If we're saving this money and it's growing and we're ultimately going to put it to its best use and not have to pay penalty, we want to make sure that we're thinking about what is qualified and what is not qualified. So walk us through some of the common qualified expenses and some of the common non-qualifying expenses.
Yeah. So typically the things that you think of that are qualifying, are kind of the common things. So that's going to be like tuition, room and board, fees associated with tuition, that type of thing. And it could be food, it could be textbooks, transportation. Those are actually the transportation is not typically part of that. But these are books and supplies. It could be expenses for special needs. A lot of the computer and technology and internet, those are all under that. And that has kind of changed over time. So a lot of it is, and I suspect, so like one of the things that people kind of get tripped up on, Tim, is like, well, like I'd like to do this, but I feel like it's too restrictive. And even in our lifetime, in even really the last 10 years, they've become the government has become more and more less and less restrictive in terms of what these dollars are for. So like,
right.
As an example, you used to not be able to use it for like trade school and things like that. Now you can. You used to not be able to, which is crazy. And they even still cap it, which I'm not sure why they do this, but you used to not be able to pay if you had money in a 529, you couldn't use that to pay your loans without that was an unqualified expense, which is crazy. Now you can. I think the cap is 10,000.
10.
So the use is broad, and I expect it to be more broad in the future. The other big thing that has changed with the 529 that has really allowed to open up other doors is you can now use it for K through 12 expenses. So Tim, if you ever were to decide to send the boys to private school, you can actually use that. And in a lot of cases, it's less of an accumulation. It's more of a pass through, because obviously your boys would be going through school now. But if you were to, if you wanted to set up a 529 for grandkids for K through 12 or even even their college, it would be more of an accumulation. So in terms of qualified expensive, it's fairly broad, and I think it's going to continue to broaden as we go, even as more non-traditional ways of education sprout up. I think that the 529 will be, I anticipate that they're going to continue to try to find ways to mitigate this issue with just rising expense and debt levels, et cetera.
Yeah, I agree with you. I think if anyone's been following along in the national conversation around student loan debt, I think it feels like we're in a direction towards what can we do to try to minimize that. And I think one way might be to loosen up even further, although to your point, it's come a long way in terms of 529 qualifying expenses. Tim, what are some other downsides, if any, to the 529 that folks might want to consider beyond potential penalties for non-qualifying expenses? We'll talk in a moment about, hey, what if my child doesn't end up going to education or going to school and using this? Any other downsides that come to mind that folks would want to at least consider and evaluate as they're making this decision?
Yeah, so some of the downsides would be, not being able to use the dollars, for like what we would consider unqualified expenses, which might be like college application and testing fees, which we know can be, fairly high. It could be, you can't use them for transportation, health insurance, extracurricular activities, and some room and board costs, which again can add up. So that's one of the things that's a downside. I think the other thing would be, the fact that, because you have to use it for higher education, and if your kid doesn't go to college, like, what do you do with the money? So I think that you don't lose the money. I think some people think like, if I put that in and they don't go to college, I can never get it back. At a minimum, you would take a haircut, a 10% penalty, and pay the taxes on those gains. And that wouldn't necessarily be ideal, but you could think really beyond traditional college. So again, I think as the government continues to look at this, whether it's helping another college with K through 12 or reassigning the 529 or basically changing the beneficiary from one kid to another, you can do that. You can transfer it to another account. It could be going back to college yourself. Like if you decide, if a kid decides that they don't want to do this, you can use it for that. or at a minimum, you can withdraw it. So, I think because if there is an iota, and again, not advice, but if there is an iota that your kid is going to do something post high school, I would plan for it. And I think it also depends on the state, because a lot of the state deductions will incentivize that. But even like the tax benefit of growing it tax free, if you're looking at 18 years, if you're looking at 10 years, those that's a real period of time where you can get a lot of gain out of an investment account, and to be able to direct. And it could be a legacy, Tim. It could be a legacy thing, Tim. Like Liam, like if Olivia doesn't want to go to school, or say she gets accepted to West Point and we don't have to need it, we don't need it because there is no tuition. It's just, time of service. We would basically shuttle that off to Liam. Liam would get the account. But then if he decided he wanted to start a business or things like that, I think what I were to do in that moment, unless I really need to use the cash, I would look at my nieces, my nephews. I would potentially look at it as a legacy thing to send my grandkids to college.
Yeah, let it ride.
Yeah, let it ride. Just let it do its thing, and allow that to be a legacy thing for me. That I know we have clients that like. The lucky few that get through pharmacy school is like, oh, my grandma and my grandpa sent us. Like, I would love to be able to give that gift.
Yeah.
I'm not thinking about that. That's chess right now. I'm not really trying to think about our kids. But if that situation will arise, I would I would take that 1/3 pool of money that we're working towards and either repurpose it for the other child or look at the next generation.
Tim, I often say when I'm speaking with a group about kind of investing 101 that, when it's something like a 401k or an IRA, step number one is you actually put the dollars in. Step number two is then you actually figure out what you're going to do once those dollars are in the account. Same thing here, right? We're talking about money that hopefully is going to grow over time, which means we've got to have some thought and intention to how we're investing that money. So clearly this is not meant to be investing advice inside of a 529, but just talk to us about how you think through that, or how you work through that process with clients of, it's great, we're saving, but now we've got options. And how do we evaluate that? And is that just a very similar process to what we'd be thinking about as we would in a 401k or in an IRA or even in a brokerage account?
So this is another big piece of like, now that we have we've identified what we want to save. And in this case, we're talking about the 529. So that's kind of the organization of the account. The second piece is the kind of the contribution / funding of it. The last piece is kind of the allocation. And this is kind of how we break down recommendations for clients. And again, it's going to be dependent on their situation, their goals, the state they live in, their tax situation, et cetera. The allocation piece is, just like retirement plans, 401ks, the by and large most popular thing that we see is the target date fund. The target date fund says, okay, if my kid's going to go to school in 2030, it basically has an allocation that changes over the year. So it goes from more equity focused the further out, and then basically changes and alters itself as it gets closer to that 2030 timeline and becomes more bond focused. So the target date fund for 529s are, that's basically how it works. Personally, I don't like target date funds, not because they don't work, they do, but more so because they're more expensive. So, for our kids, we just use like a total market. So the Maryland 529, and we're moving everything over to Ohio now. There's a total market fund that we use that, we want to be super aggressive. And then as Olivia gets closer to her, I'll just do that manually. Now I do that because that's what I do for a living. Some people, if it's kind of out of sight, out of mind, they're not working with an advisor, they maybe should look at a target date fund, but just know that the dollars are going to be a little bit higher in terms of expense ratio and things like that, because they're doing that work for you. So I think the other thing too, the reason I don't like target date funds in particular with regard to retirement is that a lot of people, the retirement date is a little bit more, it's more of a moving target. Whereas not so much with college. Most of the time, a child graduates high school and they're going to be off to college the next year. but that could be another reason, that you don't necessarily look at the target date fund. But yeah, when you look at most 529s, and again, all the 529s are not created equal. There are some that are really good, meaning they offer good, or they also offer an array of investments that are out there that are cheap. Some, there's a lot of fees and higher expense ratios that are not necessarily great for the investor. So a lot of that is dependent on the type of plan that you're in and where you're at.
Hey, that sounds like an episode we just did recently on
Yeah.
not all investments are created equal in terms of fees.
That's right.
So yeah, same thing here. Tim, one of the questions we had from the Facebook group, Ernesto asked, can you start these for nieces and nephews as one example? I guess, others may think of the same thing for grandkids. We talked about the transfer of them. So you use the example, if Olivia or Liam doesn't use it, that you might be able to transfer it to your nieces or perhaps in the future grandkids. What about actually starting or opening an account for niece, nephew, grandchild, etc.?
Yeah, you can absolutely do that. And I think maybe a downside is how it affects financial aid. So, it does affect financial aid when it's owned by a parent, but the benefits that you receive, it's going to be very slight, how it affects financial aid. For a child, you definitely don't want to have it, in the ownership in the child's name. But for someone like an uncle or a grandparent, I don't even think it's on the radar. So yeah, you can absolutely do that. Get your tax deduction too as you go, which is nice. In terms of like change in ownership, you can do I think you can do a rollover. So I can move money from Olivia to Liam.
Mm-hmm.
I think you can do that partially. You can do a partial rollover, or you can just do a straight beneficiary change where you're saying that this account is no longer for Olivia and now it's for Liam. So I think there's a wide variety of how you can kind of manipulate that, which gives you kind of maximum flexibility to kind of get the most out of the plan.
Another question we had was from Casey, which is one that I have heard before. So I know this comes up often. And in addition to giving a shout out to Kelly Reddy Hefner, which was pretty awesome, Casey asked, main question is 529 versus IRA. Should I instead put the money in an IRA so I can have more options to invest, also more flexibility if continuing education is not desired, and take out only the amount that would not give a tax penalty, i.e. after 5 years? Are the percentages to manage the accounts, 529 and IRA, usually similar? So this question I think often comes up of like, why not just use something like a Roth IRA when you think about kids' college?
Yeah, I mean, again, just like IRAs are not created equal. Obviously, I know that the IRAs that this client has are very efficient, because we want to make sure that we're not paying any fees that we don't need to. I still, I think because of the, from a tax perspective, they're still going to be very similar in terms of growth. But I think especially because if you're in a state that gets a benefit, I think it's worth it. So, what most people forget is like with like a Roth IRA, if you contribute to a Roth IRA, any dollars that you put into a Roth IRA, you can, get out of the Roth IRA penalty free and really tax free. So like your basis really for any purpose. So if I wanted to buy, a sports car, I can move money out of my Roth IRA and without penalty or tax, as long as like that it's not the earning, it's just right. That. And the same is really true for the education accounts. Like if it's used for what gets penalized is the earnings, so they don't want you to have a kind of that unfair advantage. So I still like for if there's an option for if the education stuff is on the table, I still like that, even given this idea that I think it's going to be broader and broader in terms of what what it can be used for. I still like the 529, even though typically they can be a little bit more expensive. But the thing that most people don't know is that you can basically open a 529 in any state. So if you look at the state of California, which unfortunately does not offer any type of deduction or credit for California taxes, you can go out and look at what are the best 529s that are out there. Two of the ones that are typically popular are Nevada, which is run by Vanguard, and we know why. Vanguard's very efficient and affordable, and then typically the Utah 529, which is also another good one. So you can go and open those. And I still think that the benefits you receive inside of the 529, even maybe with a little bit more expense compared to the IRA, is worth it.
Yeah, the other thing I think about, Tim, here too, in addition to the state income tax benefits, if that is applicable, is I do think there's something powerful just about the behavioral separation. Like,
Yeah.
you and I have talked about this because I asked you this question several years ago as we were just thinking about this with the boys. And I think it's true. Like, maybe the math doesn't necessarily change, but there's the kids' college bucket and then there's the retirement bucket or thinking about long-term savings. And I think, there is something valuable for having that focus where you're budgeting and thinking about one and you're budgeting and thinking about the other. Not to say you couldn't get to that same outcome if it was all in one bucket, but I think that value of separating them sometimes and having fresh attention on each of those and their individual goals can be really important.
Yeah. What I think too is like, people that can contribute to an IRA or a Roth IRA, they have to have earned income.
Yeah.
So if we were trying to open one for your son Sam, even though I think they're going to be building in this multi-million-dollar company with the Ulbrich Brothers LLC, he has to have earned income to be able to fund that IRA and use it, in the future for education. Or you carve those dollars out of your own contribution that you and Jess are putting into the IRAs, and then it's kind of like bucket confusion, which again, right. I am a big believer in clearly delineating what does this account for, what does that account for, because it can get lost in the shuffle and what are we doing, what are we not doing, type of thing. So I think the benefits, are similar, but I think when you go down to the behavioral and drawing clear lines of okay, what is this money for, and not get it kind of confused with your retirement assets, then I think that's a plus as well.
Last question I have for you here, I think is a good one because it probably will come up in this situation, but perhaps also others that might be thinking about K through 12 education. So a question here from Katie in the YFP Facebook group is, cash flowing husband's grad school, is it worth it to put it into a 529 prior to tuition being due, then pay it via the 529? So she says in Illinois, there's a significant state tax deduction. We would not be using it for the investment option since we're only saving one semester ahead.
Yeah. So yes. So in this case, you would think of the account less as an accumulation account and more as a pass through. Mm-hmm. So you would basically seed the account with what you would need for that semester of tuition, and then basically get the deduction for Illinois, and then kind of rinse and repeat until you mm-hmm. really max that out for the year. So if you lived in California, as we previously stated, that doesn't have a state deduction. I don't think Kentucky or North Carolina do either. You would, I think Maine is the last state that doesn't either. There would be no reason for you to do that, because mm-hmm. if you were trying to get like gains, the gains would be so minimum, because as right. soon as it goes in, it goes right out. So it's kind of like also sometimes when you fund a like an FSA for dependent care, it's to get that money in the account so you can get the deduction. Then you're basically paying your your daycare or whatever. It's kind of the same idea, but it's a great benefit because it every little bit helps on the tax side. So mm-hmm. And I know Illinois state taxes can be somewhat brutal.
Great stuff, Tim. Really appreciate the deeper dive into 529s. As I mentioned at the beginning of the episode, if you haven't yet done so, check out episode 195 where we talked a little bit broader about kids' college savings, and we included some of that discussion on other options beyond the 529, as well as the recent post from the YFP blog, 7 things to consider before starting a 529 plan. And for those that are, in the midst of saving for college in a 529, whether you're in the beginning of that journey, whether you're in the withdrawal phase of that journey, or perhaps again, even saving for other family members, we'd love to talk with you to see how this fits as one part, an important part, but one part of the overall financial plan. And so if you're interested in that conversation and evaluating the fee-only comprehensive financial planning that we do at YFP, make sure to book a free discovery call at yfpplanning.com. As always, we appreciate you joining and hope you have a great rest of your day. Before we wrap up today's episode of the Your Financial Pharmacist podcast, I would like to again thank this week's sponsor, Insuring Income. If you are in the market to add own occupation disability insurance, term life insurance, or both, Insuring Income would love to be your resource. Ensuring Income has relationships with all of the high-quality disability insurance and life insurance carriers that you should be considering and can help you design coverage to best protect you and your family. So head on over to insuringincome.com/your financial pharmacist, or click on their logo or link in the show notes to request quotes, ask a question, or start down your own path of learning more about this necessary protection.